Alright, welcome back. This lesson is going to be part of the Foundations of Trading series. We talk a little bit about this in the series, but I want to go into a little more detail in the risk management. So this is going to be having to deal with some of the things that we can control in a market, since we can't control price very well. And with markets being pretty volatile right now, it's good to review what you have. And if you don't have one, set some guidelines, because if we don't have some money, we can't play. So this is part of a presentation I did about designing your trading all the way around. And this is just very basic, something we can all think about and do, and set some rules and some safety valves for ourselves when it comes to managing our money, our risk. And again, we can't control much in the market, but we can control this. And so in here, what I do is I start with our constants, right? The things that we have. And even if you're sim trading, you can treat this as real. We need to know these things. Number one, you start out very simply. What's your account size? Could be 10,000, could be 10 million. You figure out how much the maximum amount to be risked, your risk reward. I'm going to show you a very simple ATR method to calculate your maximum stop size. See, once you have your stop size, you can pretty much determine the rest of these numbers here. And time available, this just thrown in here because if you're designing your trading and you're working during the day, you're not going to be spending a lot of time studying the NASDAQ tick charts for an hour in the morning. It's not going to be available. You might be doing 20-minute charts or hourly charts. And your design needs to be around this. So what we want to do is decide how much money we're going to risk on each trade maximum. Figure this out, start to write this out in your own way. Me, I am at 2%. So anywhere between 1.5 and 2% is the maximum I'm willing to risk on any given trade. 2% of my trading account. Now this doesn't mean to risk 2% on the Aussie, risk 2% on the Euro, risk 2% on the Yen, all at the same time. I'm not going to get into a whole bunch of equivalent risk here. You can get all this type of math from the internet. It's pretty simple. I just don't want 2% of my money at risk out there at any given time. Now I have a lot of freedom when it comes to my trading. I don't have too many rules. I'm here to make money. There's not a whole lot of rules when it comes to I have to take this setup or that setup or this setup or that setup. But the market offers me, I'll take. But I do stick to my rules here, and it's taboo to break them. If I don't have any money, I can't play. We're not here to make our fortunes in the same month. We have to work on doing this consistently and then let that compound. So even when wild things happen at this sort of risk, I'll take a hit, but I'm not going to lose my account. And so you can write down each instrument you trade and each time frame you trade. For example, I trade the Euro 20-minute, I trade the S&P E-mini tick chart, and then I can work out the maximum stops in those instruments, in those time frames. And we'll be talking about that in a minute. From this information, I can figure out how much I'm going to lose per trade and size myself accordingly. Now it's important. I want to know how much I can lose per trade. So, for instance, if my maximum stop is 30 ticks in a currency, we can use an example of risking 300 bucks per trade, or you can use the example of you're risking 30 bucks. We'll do 30 bucks. Whatever it is, this is very important. You want to figure out how much you can lose if you have 10 stops in a row. So if I'm risking 30 bucks per trade, I got 10 stops in a row, that's $300. If I can't swallow that, if I'm not good with that, if that's going to make me crazy, then I need to change my size and my risk. So it's very important. I get 10 stops in a row now and then. Most people will get 10 stops in a row. It's probably going to happen to you. Don't count on I'm just never going to have that happen. It's better to prepare ahead of time. If 10 stops in a row times whatever your max is going to make you nuts, don't do it. So this is a good gauge you can go by. And then we want to set some personal safety valves. Decide how much you're willing to lose per day or per week or per month before, hey, I got to quit trading for a while, and you can decide the brakes on that. It's just a safety valve. If you don't have a risk manager watching you, you got to watch yourself, and so you have to design this in. And for everybody it's different. For a day trader it's different. For a swing trader it's different. If you're day trading, generally, I get a couple stop outs, 2-3 stop outs, yeah, I'm done for the day. That kind of thing. You need to set these safety valves. If you got a few in a row, you're obviously leaning the wrong way someplace, and so you don't want to keep destroying yourself. And so you can write this down. How much per day? How much per week? You design it. You can also say how many losses in a row, day or week, before taking a break. And on the flip side, we can talk about the winning side. If you're in profit for the month, you might want to put a profit floor. It's like putting a stop under your profit. Say, I'm only going to risk losing this much before I quit trading for the rest of the month. You can do this for the month or the week. So think about some of these things. Make it your own, but put some safety valves in to slow yourself down, because we will all lose it at some point. The only caveat to all this I want to mention is if you're doing an exercise, all right, and I'll give exercises a lot of times for learning purposes. If you're doing a practice, if you need to be out here rolling around the mud trading, you need to learn something about taking stops, you need to learn something about this kind of entry. If you're doing a particular exercise, you're going to lower your size. You're going to decide how much you're willing to lose. Okay, you're just going to write the check for it and do the exercise and not worry about it. When you're doing an exercise, it's not necessarily to make money. It's to learn something. It's to get something new in your experience. So this is for your business. This is to work out for your business. And by the way, if you're not turning some kind of consistent profit now, if you haven't had, say, 3 months in a row, you can decide, I like to put 3 months of profitable trading before upping my size. But if you're not, drop your size. Trade at 0.5%. Okay? This is 0.5% or lower. Remember, 2% is maximum. You don't have to do 2%. Don't try and make your fortune this month. It's not about that. You want to set up a safe playground for you to learn. Put it at 0.5%. Give yourself a little room. Earn your right to up in your size from 0.5%. Get a couple months, then you up it. Then you up it. Then you up it. You want to build nice, slow, and steady. Build a nice foundation for your trading. All right, so here, this is basically a sheet you can fill out. I have this instrument, the euro. I trade the 20-minute, max size risks, size of account, and you can do that for everything you trade. And this is just a very basic example. All right, we did this some time ago. Example of a $10,000 account risking 1.5% per trade, so that will be 150 bucks. One thing's going to design the other. If you can only risk $150, guess what? You're not going to be trading oil futures probably. Don't even bother looking. Now, if I set it up like this, and I have the Aussie 20-minute, I'm trading a 20-minute time frame, I'm going to figure out my maximum stop in ticks. So the last time I did this, my maximum stop was 25 ticks. That's going to tell me the size I can use. So for instance, a lot in Forex is going to be about 100,000. Figure every 10,000 is about $1 a tick. So 60,000 is going to be $6 per tick. $6 times 25 ticks is 150. I'm all good to go to trade this with 25 tick stops and fit my parameters of my account. If I'm trading ES E-mini futures, I used to trade a lot of the 3-minute. Back when it was 3 points was my maximum stop. We haven't seen that lately. So it's one contract. You just do the math and say, oh, I can trade that. If you're trading oil and it's more than $150, well, then you're not going to do oil. And over here, this is a lower your size example, to do a 0.5%. For instance, in the Aussie 20-minute, 25 tick, I can lower my size down to 20,000, risk $2 per tick. So even though this is my max, if I'm learning or if I'm even having trouble, I will lower my size. And you decide. I recommend, 0.5% or lower as you're learning or as you need to get a handle back on this thing. All right, so now let's talk about how we get the maximum tick size. All right, so let's get the current maximum stop for the Aussie. Now, what I do is I basically use an ATR, which is average true range. You'll see almost every charting platform will have that. I use a small one and a bigger one, meaning 200 and a 34. You can choose whatever numbers you want. And all this indicator does is it takes the bars, the high to low, the size of the range of each bar. So you see it's 32, and over here in black, that's the actual bar, not the average. So it takes that, you take 32 of these bars, and it comes up with an average. So whichever one of these numbers is bigger from either the 34 or the 200, I'm looking in the green, is the number I'm going to use. So over here we'll see my average true range is 20. You can see it in the green. So my average true range, meaning the average range of each one of these bars, is 20 ticks. You can't get away with the same old 12 ticks you were using last month. Volatility has picked up, and it's good to stay in touch with. So all we're going to do is take that 20 and double it. This is back of the envelope. You need to do a longer presentation to fine-tune this, but back of the envelope, if you take the 20, you double it, it will become, this will become 40 ticks max. Then obviously your size would adjust. The futures, believe it or not, used to be 3 points on a 3-minute. But if we come over here, pick out a 3-minute ES, it's now 11. You double 11, and this is going to be a lot more than 3 points. So this is going to be out. No can do. But that's the basic way to come up with a maximum stop size. If you have your own method, use your own method. It doesn't matter. That's my quick method to come up with it. There's more to it. We make it proportional with the swings. But come up with it any way that you use and say this is the maximum number of ticks I'm going to use. That will determine the rest of it. All right, so fill some of this out for each instrument that you have so you know it, so it's in front of you. So you say, all right, hey, it's too much, I don't do it. Or if it's this much, I lower my size. If the whole thing's out of whack, I quit trading till things come back into whack. Okay, so hopefully you enjoyed this. Make it your own. This is basic, it's very simple. You don't need a whole lot of portfolio math to do something to figure out what your maximum dollar loss is going to be per trade and how much you're going to risk percent wise of your account per trade.